Hello, Slope of Hopers. Slopers of Hope, I guess, would be better. Tim Knight here, with increasing frequency on these videos. What a day, interesting day. So, the euro, let's start with that. I will, as we all know, in order for the bear equity case to return with any sort of credibility, we gotta take out this low. We gotta punch through that post-Thanksgiving low on the euro. Without that, all hope is lost. We don't want to see a resumption of that march higher like we did through the horrible, dreadful, sickening month of October. Like that, we don't want to see that. Not that our desire to see or not see something has anything to do with anything, but as far as what things to look for, taking out this low, and then this low, and most importantly, this low, is what would really pave the way, because this supporting trend line here is doing its job. It's supporting the market. Now, a little more optimistically, as we zoom in on this portion, here's the giant, massive central bank swap line announcement, whoosh, and the doodling around, and then we have our drop here, which really negated about 3/4 of all that. And then we started to kind of repave the way for another breakout. And as of this morning, it looked like the darling euro was getting there. In fact, if we zoom in tighter, we can see, actually real tight here, we can see this latest boom, which was eerily enough a minute or two before the market opened, when SlimFast user Merkel and Sarkozy came out and said, we're in total agreement, everything's just peaches and cream, and the euro shot higher. And it didn't last long. It just kind of wasted away, sort of like too much SlimFast. And then a couple hours later, exactly 2 hours later, all the good that did was laid waste. But then it got really interesting later, as we all know, because as the day worked its way forward, S&P did their magic, and this credit negative news came out, and boom, boom, down it goes. So we are now really kind of at the midway point in the big boom that we saw, I guess last Monday, a week ago. And who knows what's next? Who knows what's next? This market, I mean, just look at these drops just out of the blue, and look at these rises out of the blue. I joke that we're all Forex traders, and it is true, but I'm glad I'm not a real Forex trader, because those 100x accounts will kill you. And by that I mean the leverage. The leverage is just excessive. So moves like this have probably wiped out a lot of retail accounts in short order. So, as far as the ES goes, we're still in intraday mode here. This will be the past 60 days on a 1-minute basis. And I'm just going to kind of stall here because this takes a while to load. So, I guess after the close, instead of rumor, it became fact that they were doing this downgrade. I mean, it is somewhat telling. I mean, think of it. When the United States was just inch lower to, we're a double A now, so it's a notch above their very highest one, which I don't know. I guess I'm naive, but thinking that the creditworthiness of the United States is second from the highest possible rating seems insane, but there you have it. Anyway, that caused staggering amounts of market damage, whereas today, what was it, 15 or 17 nations, big nations, were put on credit watch negative, and all that happened was that the obscene gains from earlier were trimmed. You would expect something, I don't know, more dramatic, but we'll see. Hey, I'll take it. I'll take a little drop. I'll take any drop at this point. So let's get out of this intraday business and move to, I don't know, we'll move to like a 2-year basis and see what comes up. Actually, let's make it a 5-year. As a general thing to point out, I just wanted to bring up the interest rate chart, $TNX, to kind of illustrate what is being attempted right now. We'll change this to a line graph to make it a little more obvious, and we'll get rid of all this drawn objects. So this was QE1. This was the Fed's push to inflate. And as you can see, it was quite effective. That's when there was the most oomph, to use a technical term, with QE1. And after a while, heaven forbid, natural forces started to take hold again. And then QE2 was introduced. And far more expensive, but less of a voomp here. Maybe about 70% of the effect, just looking at this graph. And then natural forces start their evil work again, and things start to head the way they're supposed to head. And now we're getting QE3. Not a lot of voomp going on. In fact, it kind of reminds me of, this is sort of like when things were like dry tinder and one match set things on fire. And then there's some mist in the air, but it's still pretty good kindling. We'll get a bit of a fire. And now, I don't know, Janet Yellen has gotten incontinence or something, and it's kind of wet tinder at this point, and there's just not a lot of action happening. Now, it took a little while for these things to really catch fire, so I could be wrong. This thing could be headed back to, I don't know, 3% or something like that. But I'm simply pointing this out to illustrate that in spite of continued efforts to do a three-peat here, so far hasn't done diddly squat, to throw another technical term at you. Now, the Russell was the strongest index today, the Russell 2000, $RUT. Let's bring our drawn objects back again. And a couple of thresholds I'm slightly nervously watching here. First one on the RUT is 759.13, not to put too fine a point on it. That's the close of that gap from back on October 28. And then if we cross that, boo. But the next one I'll be watching is 771.71. If we cross that, then Tim gets very sad, because that really kind of clears the path for moving higher still to yet another gap. So, we're taking it a day at a time. This topping pattern is still very firmly in place. This gap is still in place. But with all the shenanigans that are going on, you never know how long things will stay in place. Dollar SPX, the S&P 500, getting pretty close to this descending trend line here. Lot of action here, about 100 points or so in just a few days, thanks to the sweet peas over at various governments doing their magic. A lot of fear, of course, has been taken out of the market. If we look at the VIX, we can see that the big peak on this one was October 4, just when things were getting fun. I think when the VIX gets to this level, that's when you know they're going to take the punch bowl away. And we've really tumbled hard back to the high 20s, which is an area we've been in for some months now. Definitely at the lower end of the range we've been in since things kind of shook up this summer. Looking at crude oil, still kind of mashed up against this trend line. We pierced it a bit, sank away, and had another oomph at it here. Kind of stuck at that century mark. So I would also add that based on what happened over the weekend with the drone getting shot down and so forth, the fact that, and Iran doing their oil's going to 250 a barrel shtick. I guess no one really believes Ahmadinejad. How do you say it? Ahmadinejad, something close to that. Something close. The head of the place. Ahmadinejad. Okay, that's close. What else? Oh yeah, let's take a look at the Huey again here. This is the Gold Bugs Index. And I did my little grid shtick back on Friday, I think, with you guys. I'm going to have to get a 10-year on this one. But let's do it again, just for grins, because I really do think this is an interesting exercise. And I'm kind of monitoring this, trying to divine if our analog is holding. Where are we? So let's just do this in real time here. Take a little fine-tuning. Yeah, it wasn't bad. Gosh, you think I'd planned it or something. That's pretty damn good. So you can see how these line up. So here's present, and here's the past, and I've marked this peak. I've got a lower level here, and we haven't broken beneath it, so let's edge this back a bit like so, and let's scooch this guy. We can scooch him a bit. There we go. So what we're trying to do here is find out right about where we are. So this is one peak here, and then we've got our line busting peak up here, and from that we had a descent and a retracement to that formerly broken line, and then a deeper descent and a push higher. And so here we have a descent and a retracement back to that line, and a descent and pushing higher. So where are we now? We perhaps around here, I would say, which puts us around May 2008. So the bad news is that it suggests that not only are we not about to break, but we even might have a bit more of a push higher. Hard to say, but that's kind of what this analog says. Some folks, I mean, anytime you bring these analogs, people are like, well, it's different this time, famous quote. I know it's different. I know that, everything's different. Still, you can't deny that thus far, this comparison plays out in a rather interesting way. And of course, what we want to see, if the analog holds, is a continuation of that kind of glorious drop that we had seen beforehand. All right. Another reason I'm feeling that the bullishness of some may be misplaced is that even when I, from a pure charting perspective, try to pick out some textbook classic bullish-looking patterns, those haven't done so well. Let me show you what I mean. Let's show you a couple. One was Activision, and let's hide recent activity. So in this case, long consolidation over multiple years, very clear breakout level, broke above it, retraced to it, everything that you want to see. Everything you want to see, because once it broke above it, a handsome, strong move on nicely growing volume. So to this point, let's take a bit more. To this point, this was acting properly. This is sort of how it's supposed to go. So even a bear like me can find bullish-looking patterns. But look what's happened afterward. It sank down again, broke beneath the breakout level badly, and is sort of coming back to what used to be support and is now resistance. So this, I don't think it's going to pass through that line again. So what should have been a really bullish chart sucks. And in fact, it's probably just going to fall and eventually get down to this lower level beneath $10. Another more speculative example was OPK, gigantic multi-year breakout, the kind of thing that has every potential of producing multi-hundred or even multi-thousand% gains over the years. Just lame. Consolidation, breakout, kind of withers away, and this is the deadly part, breaks beneath that breakout point, and it's just doodling around here at that former level. So once again, something that should have been a nice, robust breakout going limp. So I'm not long anything right now. In fact, I sort of made a decision, and Friday kind of did it for me, because I handpicked very carefully some long positions to sort of hedge things, and they all just, like this one, kind of went limp on me. So I've really made a pact with myself that my long position is going to be cash, and I'm simply going to have fewer shorts or more shorts depending on how aggressive I want to be. But this mixed bag in this market, no, it just doesn't cut the mustard. So, all right, good. That's it for me. Just my portfolio update. I am in shorts only. Commitment level is 35%, therefore 65% cash. And those shorts are distributed amongst how many positions? Let's find out. 44. So kind of a double death number for you Chinese astrology types. That's it. Good night, everybody. I'll see you on Tuesday.